But with this, let's move on and let's put the spotlight on Star Health Insurance and let's understand what is the outlook on the business going ahead. We are being joined by Anand Roy, who is the MD and CEO of the company. Hi, good morning, Mr. Roy, and it's been great speaking with you. But first up, let's talk about your combined ratio. Earlier, you were expecting a 100 bips improvement over there, but adverse market situations and higher claims ratio actually resulted in an otherwise scenario. For the exit FY25, where can we expect the combined ratio to be for the company? Give us some sense there.
The company has done very well on the growth side. We have grown our new business by 25% on the retail and overall growth by 15%. On the operations, the company has also done well on the operating expenses. We have the best expense of management as per the regulatory norms, which is around 30-odd%. On the claims ratio side, there has been an elevation in the claims ratio this year for Star Health. We expected some improvement in the claims ratio as compared to the last year, but there has been an elevation, and this has been true for our company as well as for the entire industry. And there are multiple reasons for this. We have seen definitely a higher medical inflation in terms of the severity of claims this year. We have also seen multiple regulatory interventions and reforms which are more customer-centric in nature, which has led to some amount of elevation in the claims ratio. However, the company has taken multiple measures to ensure that the future performance of the company remains stable in terms of price corrections in few products, as well as certain underwriting changes. So we believe that going forward, the claims ratio should be well under control as per our expectations.
Okay, thanks for that, Mr. Roy. This is Nehi also joining in, and you've highlighted the changing dynamics of your claims ratio and its impact on the overall industry. Now, earlier you announced price hikes more than anticipated to tackle these challenges. Help us understand how much of the price hike has been undertaken so far, if there is any more on the cards, and when will it yield in supporting the combined ratio?
Price hikes has been always a feature which is linked to medical inflation. Insurance companies' price revisions are tightly regulated and reported to the IRDAI. But the medical inflation in India continues to be unabated, and as a result of which, all companies have taken a price increase, including us. We have taken a price increase in almost 6 products, some of them for the first time, and some products maybe on a repeat model. And we believe that any price revisions you take in insurance plans kind of plays out over the next 12 to 18 months. So the price corrections that we have taken will reflect in our books in the next 12 to 18 months period.
Also help us understand what's your read-through for the industry in terms of the claims ratio, and do you see the landscape is changing or is likely to remain elevated?
See, it has been a constant ask that health insurance and healthcare industries are two sides of the same coin. One side of the coin is tightly regulated and the other side is unregulated. We have been always vocal about a need for a healthcare regulator to bring about some kind of price discipline on the healthcare expenses side. If healthcare expenses continue to grow unabated in India, health insurance premiums are also likely to rise. And it is an unfortunate situation right now that we are facing. But having said that, we are working very closely with our partners in terms of our hospital partners, and we are working closely we have more than 14,000 hospitals on our network. We are working closely with them to arrive at certain price arrangements so that the consumers can benefit from it, and there should not be increase in prices frequently. So this is an effort we are putting in, but it will also be helpful for the entire ecosystem if some kind of price discipline can be brought in the healthcare, healthcare industry itself.
Mr. Roy, point taken, but if we look at the general insurers data for the month of March, it seems that your company's premium income growth for FY25 was at roughly 10%, versus standalone health insurers growing at 16%, a mild underperformance versus your aim to grow at least 1.1 to 1.2 times higher than the industry. Tell us what impacted the growth and help us understand where you see growth headed in FY26.
The industry we operate in is a general insurance industry, and Star Health has grown faster than the general insurance industry. The general insurance industry has grown at around 6 odd percent. We have grown at 11%. And I think we have also increased our market share in the general insurance industry. We do not break it further into multiple cohorts like Sahi or private or public sector. We look at the overall general insurance industry and how we can increase our market share in that space. Within the general insurance industry, we have health insurance as a line of business. And within that health insurance line of business also, we have grown equally with the industry, and we expect to grow faster in the years ahead and improve our market share.
All right, but on the other hand, for the last few quarters, the profitability is aided by the investment income. What we saw that the markets were turbulent in Q4, and we also saw rate cuts from the RBI. With this, how should one expect your investment income to come out in Q4? And will the fall in the bond yields result in any higher gains in your portfolio?
So yes, the investment book of the company is very fixed income focused, and over the last 2 years we have been also looking at equity as a portfolio. We have invested almost 15 odd percent in equity and equity like structures. So we continue to do that. Our investment yields have been close to 7.5, 7.6 in terms of performance, and we hope to maintain that. Not only are we looking at opportunities in good quality bonds, but also we are looking at how we can look at some innovative assets like InvITs and REITs and ETFs, so that we can keep our investment yields as per our targets.
Mr. Roy, in terms of your guidance going ahead, you have mentioned about 2x top line growth, 3x PAT growth, and market share of 35% in retail health by FY28. Do you believe the company is well on track to achieve this guidance?
Absolutely. We are very well on track. Last year, we have completed 16,700 crores. But this is, there has been an impact on the reporting of the numbers because of the change in regulations in October, where 1/n reporting structure came in. If you leave that out, we have done 17,500 crores and grown at 15 odd percent. This year, we hope to grow at around 16 to 17% and clock a top line of around 21,000 crores, 20 to 21,000 crores. And we are well on track to get to our aspirational target of 30,000 crores by FY28. As far as profitability is concerned, we believe that the right measure of the company's profitability is on IFRS results, which we will be announcing from this financial year onwards. And a tripling of profits, which we had guided for by FY28 to 2,500 crores, we are very much confident that we will achieve that.
All right, and lastly, what's the strategy for FY26? Give us some sense there.
In FY26, the plan is to increase our market share in retail business. We want to focus on the 4 distribution channels that we have, which is agency, bancassurance, corporate, and digital. And doubling down on all these 4 channels, we want to increase our market share. This year, our market share has remained stable at 33%. We hope to increase it by a few basis points in the FY26. How are we going to do that? We want to introduce innovative products. We have recently introduced a product called Superstar, which is one of the best-selling products in the market today. And we want to bring more innovations around that product so that we can cater to all segments of the customer in all parts of the nation. And in addition to that, the focus would be on improving the customer experience through digital tools, especially the Star Health customer app, where today we have more than 1 crore downloads of the app, and customers can avail of all facilities, whether it is in terms of claims, whether it is in terms of renewals of their policies, or in terms of, taking their wellness benefits and preventive health checkups. All of these facilities are available on the Star Health app, and we will drive adoption of this app even more so that customer experience, both for claimants and for non-claimants, can improve. I think with this, growth strategy as well as customer experience led through digital tools will be our overall strategy for the year.
Okay, Mr. Roy, thanks so much for joining us. And on that note, we'll let you go. Once again, thanks for joining us this morning on ET Now.
If you like this video, then like, share and subscribe to ET Now.